According to news sites, it will become even harder for people under 35 years with little savings to buy a house or an apartment. Soon it will be impossible to buy a place of your own. What's up everyone, my name is Joris, welcome back to my finance channel. The European Banking Authority has imposed new regulations for the Belgian banks to lend out money for mortgages. Their main goal is to shield banks against the high outstanding loans and to target the recent price explosion on the housing market here in Belgium. The average house prices have been going up extremely fast over the last few decades. Belgian bank KBC publishes a yearly study on the housing market and concludes that the housing market is overvalued by 60%. They calculated this number by comparing the housing prices to the average household income. If you look at this metric, you can see that the housing prices have been extremely overvalued since 2006 and 2008. But this graph doesn't show all determinants. This graph is also a bit too basic to value real estate market in Belgium. Ever since the economic crisis in 2008, interest rates have been dropping to a point where they are negative at the moment. This has a direct impact on mortgage rates, which also are on bottom levels. A mortgage rate of 1% or even lower is not that uncommon these days. Lower interest rates mean that your monthly mortgage payments will consist of more capital and less interest payments. This in turn has a direct result in you paying less per month. If you were to lend 250,000 euros on 25 years at an interest rate of 3.5% like you would have a few years ago, you'd be paying off 527 euros in capital and 718 euros in interest, for a total of 1,245 euros in the first month. If interest rates drop down to 1.5% like today, those amounts change to 689 euros in capital and 311 euros in interest, a total of 999 euros in the first month. Interest rates have a major impact on your monthly payments. The lower the interest rate, the lower the interest rate payments, and the lower your monthly payments. Or the more money you can lend for the same monthly payments. And this is what happened over the last decade. The interest rates plummeted, so even though people didn't per se earn more, they could lend more. Lower interest rates mean lower lending costs. If people lend 250,000 euros on 25 years with an interest rate of 3.5% in 2010, they paid 1,245 euros per month. Nowadays, they can lend up to 310,000 euros on 25 years with an interest rate of 1.5% and still only pay the same 1,240 euros per month. That is 28% more to lend for the same monthly payments. This drop in interest rates also supports real estate prices. People are paying a lot more for their properties, but what do they care? On a monthly basis, they're not paying anything more compared to what they have been paying a decade ago. KBC also added interest rates into their calculations of the real estate values. This graph shows the ratio of house prices to disposable income per household, but this time with interest rates taken into account. At this point, we can see that the housing market is overvalued by 14% in Flanders. This rate is high, but it is nothing compared to the 80s and 2008. That being said, the housing market has seen a boom in prices during the last few years due to the pandemic, with prices of real estate rising over 7% year on year. And not just in Belgium, our neighboring countries also saw a huge rise in prices. Lower interest rates and a house shortage caused the massive rise in prices. And this is during a time that the younger generation wants to buy their home. But now they just can't. The European Banking Authority has told all Belgian banks that they are not allowed to lend out more money than the actual value of the property. Starting New Year 2022, the banks won't lend you a single euro over the proper price. Everything over that price has to be paid personally by the lenders. Let's look at an example. You find your perfect house. It is listed at 380,000 euros. You offer 400,000 euros and the offer gets accepted. Now the bank will do a valuation of the property. If that valuation turned out that the true worth of the property is only 350,000 euros, you as a buyer will have to put in the 50,000 euros difference in your own money and you won't be able to lend that part. You used to be, but now you can't anymore. If you then look at the cost for that specific property, you are paying 10% in registration fees. 6% if it's your first property, but let's work with the first example. And then you are paying around 10,000 euros in diverse notary and bank fees. That is already 50,000 euros together. Then you are paying your bid over the real value of 50,000 euros. You're down already 100,000 euros. Then most banks will ask you for a 20% down payment. 20% of the real value of 350,000 euros is 70,000 euros. Total down payment upfront 170,000 euros on a property you bid 400,000 on. Almost no one younger than 35 years of age has this amount of money saved up just to buy a house or an apartment. It will be a very frustrating experience. People will go to the bank and they will calculate how much they can lend with their current savings and their current income. Then they will place a bid on a property they think they can buy, they can afford. They will follow through the whole sale process only to hear at the end of the process that their bid is over the real value of the property and they have to come up with the difference themselves. Since they already were at their limit because they asked what their limit was, they just won't be able to buy that property. It will lead to a whole lot of frustration for first-time buyers. And for the sellers as well. You don't want to go through the whole sale process just to hear that your potential buyers won't be able to come up with the money. Such a waste of time. I'm seriously questioning this way of working. Banks won't send out individual appraisers every time someone wants to buy a house, but they can also work with advanced statistical models that are compliant with the European Banking Authority requirements. But in what way will these models be flexible and how can they pinpoint a specific value of a property? If we, for example, request an online valuation on Imoweb, Belgium's greatest or largest Immo website, who also uses statistical models, we get a valuation that is hugely vague. I did a random valuation and the resulting price went from 507,000 euros to 761,000 euros. The upper region is 50% higher than the lower region. How can banks decide what the real value is? This new ruling is here to protect the banks and to limit the rise in real estate prices. In my opinion, people will continue to buy overpriced real estate since it is still one of the best assets to invest in. Furthermore, the older generation that has a lot of money saved up, cash, they won't worry about the extra costs of overbidding, since they'd be putting in more money anyway. This ruling will limit first-time buyers a lot, and it will make sure that the younger generation continues to rent for years to come. Again, this is horrible news for the younger generation. I don't think it will lower real estate prices anyway. It will only speed up the shift of the real estate ownership to the happy few who make a lot of money. It will turn real estate into a service where people can subscribe to but won't ever be able to be an owner of. Once this rule is in place, banks can still decide if they want to be very strict with these new rulings or not. They can still say, well, we will lend you more than 80% of the value of the house. We can even give you 90% or in some cases 100% of the value of the house. But still this will be to a very select few people, and most often these people are already good clients with the bank. So basically people with little money who didn't save up much, they won't be able to lend more. It's just risk management by the banks. The banks are open to more risk with clients they know that have a lot of money, and they are very, very strict on the new rulings with people that can't afford it. The rich get richer, and the younger generation will have to rent for years before being able to buy a home. If they even will be able to do so, because they will need a large sum of money to start out with. And that's why it is majorly important to save as much as you can. And if you don't have a savings habit just yet, I suggest starting out very small. By saving a very small amount of money every week, you'll end up with a lot of money over time. At the start of this year, I started a savings challenge, and I challenged all of you to do it with me. If you haven't started saving just yet, it's never too late to start. If you want more information about this specific savings challenge, I'll link the video in the description below. So far, since New Year 2021, in this extra savings challenge, I have saved up 3,120 euros. I'm saving over 150 euros per week now, 4 euros more every week compared to the previous one. At the end of this year, I will end up with 5,512 euros in extra savings. That is a lot of extra money for very little effort and a nice savings habit put in place. If you then transform this small savings challenge into a good savings habit, you'll be able to save a lot more money in a short period of time. In today's real estate market, you'll need a lot of down payment to be able to buy your own place to live in. So be sure to start saving as much as you can and as soon as you can. Good luck, and don't forget to like the video for the YouTube algorithm and subscribe to the channel if you have not subscribed already. Hit the notification bell to be alerted when a new video comes out. I thank you very much for watching, and I will see you in the next one.